Hey guys, I hope you all are doing great. Welcome to the next episode of the Audit Practically series. Well, it's been a long while since I did an episode in the Audit Practically series, so I thought why not do it now? So because it's either now or never. So what are you waiting for? Let's move on to the FSLA which we are going to be looking at today. So today we're going to be looking at property, plant, and equipment, guys. A very interesting financial statement line item, and we'll also be covering capital work in progress along with property, plant, and equipment. So what are you waiting for? Let's move on. I'll just start presenting my screen, guys, and just a moment. Yep, I think it's visible now. Just a moment. Yep, just going all the way up there. Perfect. Okay, so first let's start off with which standard covers this. So if you're looking at an AS client, it's AS10. If you're looking at an Ind AS client, it's Ind AS 16, which covers this. So guys, let's look at how a lead grouping and subgrouping for property, plant, and equipment looks like. Guys, we have already discussed the concept of lead grouping and subgrouping as a part of OPEX and payroll episodes as well. In case you want a detailed understanding, you could check out the OPEX video because that was really elaborate. No worries, but anyways, I'll just break it down here as well in a very brief manner. So guys, so if you look at the face of the financials, property, plant, and equipment, that is the heading, or that is the header that is going to be appearing on the face of the schedule 3 financials, right? So that's why it's called the lead. So let's say the property, plant, and equipment that is there in the financial statements is rupees 100. So how will this 100 be bifurcated, guys? This 100 will be bifurcated into various kinds of assets which are in the nature of property, plant, and equipment. For example, land of 10, building of 5, plant and equipment of 68, furnitures and fixtures of 7, office equipment of 5, vehicles of 5. So all this would sum up to 100. Perfect. So this is the grouping. So this is how it would look in the notes to accounts. Anyways, at the end of the video, we will be looking at how the actual notes to accounts in relation to property, plant, and equipment looks like. So don't need to really worry about that, but I'll just give you a gist here, no worries. And the subgrouping. So basically, how will this flow from our accounting software or the ERP which you're using? Let's say the entity is using SAP to account the transactions. How will it be flowing? So basically, we saw that the amount of land was 10 rupees. So let's say there is a GL code called 281010 for land. Let's say land 1 is of 6 rupees. Let's say there's 281011. Land 2 is of 4 rupees. So 6 plus 4, it would add up to 10. Okay, next buildings. So we have buildings of 5 rupees. So let's say we have the GL code 231010 for buildings, and it's of 7 rupees. So 7 rupees is basically the gross block value. And if it just come down a bit, we have building act up, that is GL code 231011 of -2. So 7 is the gross block, 2 is the act up, and we have a net book value of 5 rupees, which is what is basically getting reflected here. Guys, I hope you understood this. This is how the lead grouping and subgrouping works. So this is how it's for the other values as well. Like for plant and equipment, it's 68. If you just see here, it is coming to 70 plus 10 minus 2 minus 10, and it's 68. And similarly, if I just come for furnitures and fixtures, it's 10 minus 3, 7. For office equipment, it's 7 minus 2, 5. For vehicles, it's 7 minus 2, 5. And so on and so forth, we are deriving a total of 100, which is again tying out to the face of the financials. I hope you understood this, guys. This is how the flow works. So yeah, now we move on to the audit procedures, guys. So what are the audit procedures we need to be doing for capital work in progress? Let's first look at capital work in progress. Then let's move on to PPE, because you need to understand what capital work in progress is and how it works to get an understanding of how PPE works. It's very simple. Let us say I am a company which is into the production of sugar. Let's say I am constructing a boiler. So a boiler is a very heavy equipment. It's a heavy equipment that requires a lot of materials to be erected, to be assembled, to manufacture the same, right? I hope I understood this. So for the materials to be erected and assembled, we need to get these materials. We need to start the work in relation to the same. Let's say on the balance sheet date, as at March 31, this boiler is not completed. That is, the erection and assembly of the same is not completed as at March 31. Then the asset would be classified under capital work in progress. Suppose the same is completed, it would be moved to property, plant, and equipment, and depreciation would be done for the same. When the asset is in capital work in progress, depreciation would not be done for the same because the asset is not ready for intended use. This is what your AS10 or Ind AS 16 as well says, guys. I hope you're able to recollect this and correlate this. Yep. So now let's look at how capital work in progress looks like. Like, how does the movement look like? So you have an opening number. Let's say you have an opening of 100 here, guys. So how will you trace this number? Obviously, this is the number which would have been there in the previous year financial statements, because capital work in progress again appears on the face of the financials, right? You can just go back to the previous year financials and try to trace this number, and it will match quite a bit, right? Perfect. Let's say you have addition of 20. What is meant by addition to CWIP? Let's say, guys, I purchase some materials in relation to that boiler plant. That is regarded as an addition to CWIP. So this is how the entry flow will be passed. So the initial entry flow for the materials being purchased is CWIP account debit to GRIR. Then your GRIR account will be debited and your credit will go to your capital creditors. Sorry, I mentioned trade payables here. It will go to your capital creditors. My bad. So basically, we have also discussed the logic of GRIR in our OPEX video. So you can maybe go there and understand the detailed logic for the same. Though I don't want to be explaining that again here. So yeah. And next is write-off. Guys, what is write-off? Let's say our company is doing an experimental construction project. Let's say our company is like looking to construct a new boiler, a boiler that has not been like constructed before in the market. Let's say the company starts constructing the boiler, but at a point of time, they realize that, okay, if we go ahead further with the construction of this boiler, this is not going to work out because this technology is flawed in some way or the other. So they decide to like take down everything or dismantle everything or break down everything. So in this case, what would happen is the asset would be sitting in capital work in progress, but it would have to be derecognized now. So basically the entry which we will be passing is we'll debit our P&L account and we'll credit our capital work in progress. So basically it's a charge to P&L, guys. So this is what is meant by write-off. When we feel that the project is not feasible or sustainable, we start dismantling it or taking it down, or we feel that it's not viable to go ahead with it in the future. That's when a write-off actually takes place. A write-off is not very usual, guys, but it does happen in some cases. And next, transfer to PPE. What is meant by transfer to PPE? Guys, as I said earlier, if the boiler gets completed, the boiler will be moved from capital work in progress to property, plant, and equipment. So basically, at the time, the entry you would be passing is your property, plant, and equipment debit, and your capital work in progress would be credited. I hope you understood this, guys. Yeah. So now let's just look at the testing strategy for each of these items, guys. So basically, for opening, we said that we are going to trace it to the previous year financials. So that is not a very big deal. I mean, and so we basically need to look at the testing strategy for additions, write-off, and transfer to PPE. Okay. And for closing balance, we don't need to do any testing, guys, because basically we are tracing the opening to our previous year financials. For addition, write-off, and transfer, I told you that I'll be explaining the testing strategy now. And your closing balance is basically derived balance. Since you have already tested everything that is leading you to the closing balance, you don't need to do a separate testing for your closing balance. I hope you understood this, guys. Next, the testing strategy. How would we test additions, guys? So additions, first we will have two kinds of listings in relation to additions, guys. So first what we would be doing is, we saw that the addition number here was 20. So basically we need to get a comfort over the number of 20. Sorry guys, just a moment. Sorry. Yep. So first we need to get a comfort over the number of 20. Like we need to ensure that the number of 20 is complete. So we would have two CWIP schedules usually, guys. One would be an asset-wise CWIP schedule. So if you have an SAP client, ideally the T code, that is the code which you have to input to get this listing, would be AR01. So basically there would be a list of assets, like your boiler would be one of the assets, your wind turbine would be one of the assets. So each of these assets would have an asset code or a CWIP ID. So there would be a listing which would be having CWIP ID wise assets, and the total of the same would be adding up to whatever is there, right? So basically you need to ensure that the total of this listing is actually matching to 20, because that is when we get a comfort over the completeness. I hope you understood this, guys. Okay, there is also a second listing, guys. You might be confused as to what is the second listing, sir? What is the second listing, boss? Very simple, guys. So the second listing, as I told you earlier, this is the entry which you will be passing for CWIP addition. CWIP account debit to GRIR, GRIR debit to your capital creditors. I hope you understood this. So what would happen is, if we go to the GRIR GL dump, these amounts would be traceable there. So what we would do is, we would go to the GRIR dump specifically for the CWIP, and we would extract the same, and we would ensure that the total of the same is also matching to 20, right? So this can either be extracted from FBL3N or FAGLL03, or there is again a custom report in SAP called ZPDB, or sometimes it is manually prepared by the client. So if it's a very, very voluminous CWIP balance or CWIP addition amount that is coming out, it is usually manually prepared and then again cross-verified with the system. So this is what the client will be giving you, guys. But you guys should be thinking, why do we need two listings, boss? Like we can just go ahead with one listing. Yep. So that is where I'm going to break it down, guys. Just a moment. Yeah. So for the first listing which we need is basically to analyze at an asset ID level, because we need to know what is happening inside that asset. What is the addition that is inside that asset? What is the deletion that is inside the asset? That is, by deletion, I mean what is the transfer that is going to PP. That is what amount of the asset has been completed due to which it is getting moved to PP. I hope you understood this. The second listing, that is a GRN wise listing, is very, very critical because that is the listing using which we will do the testing and our sampling. Because let's say there is a boiler, guys. A boiler requires a lot of materials and a lot of labor work also has to be done in relation to the boiler, right? So what would happen is, let's say the boiler requires 10 materials. So if you go to a GRN wise listing, there would be 10 line items in relation to the boiler. So, but if you go to your asset ID listing, there would just be a single value, or which would be the summation of the 10 materials that would be required. So if you take the CWIP ID wise listing, you would have to again go back to the GRN wise listing to find the mapping of the 10 materials. So in such a scenario, it would be better to select the GRN wise item wise listing, because in such a scenario, you're taking each and every line item, and for each GRN, in most of the cases, the GRN would be mapped to only one invoice. So your testing would also be easy, in the sense that if you're selecting a particular GRN, you would be able to trace it to a particular invoice. But if you're selecting the samples from the CWIP ID listing, the same would be the summation of multiple invoices. So it would be difficult for you to map from the CWIP ID listing as to which invoices are comprised in a particular asset. So it is better to break it down into GRN wise and proceed. I hope you understood the logic as to why we are selecting the GRN wise listing for our testing, guys. Yeah. So let's move on to how we test and what do we test, guys. So yeah. So testing format for your CWIP additions. So first, let's say there is a shed under construction. Let's say the CWIP ID of the shed is 8002678. Let's say the amount as per listing is 10. That is your amount as per your CWIP listing, and your GRN wise CWIP listing as well comes out to 10. Let's say the amount as per invoice, PO, and GRN. So what you will do is, this GRN is there amounting to 10. You will check whether the invoice for this material also has a value of 10. If it has a value of 10, great. That's perfectly fine. You also need to check whether the PO value also amounts to 10. Usually the PO value would be higher because the PO is for multiple transactions, and this would just be one of the materials that would be forming part of the PO. So you just need to check the item wise list in the PO and check whether the rate for this item amounts to 10. If the rate for this item in the PO amounts to 10, it's perfectly fine. We are good to go, guys. And similarly, we also need to check the gate entry number, the GRN number, and the invoice number and the invoice date to see that it is tying out to the date on which the item entered the CWIP listing. And if there are no differences, we have no concerns over the same, and we are good to go, and we are good to proceed to the next step. I hope you understood this, guys. And okay, in relation to write-off, I discussed with you on what is actually write-off, guys. So many of you would be having this doubt as to, boss, you explained us the template for additions testing and how to test the same, right? Can you just explain the same for write-offs as well? No worries, guys. I will explain it to you. So write-offs, what would be happening is, as I told you, once the asset is written off, you would be taking a charge in P&L. So basically, there are two things you can basically do in relation to write-off. You can check the mail approval from the particular plant controller to ensure that the write-off has been done duly with this approval. And you can maybe visit the plant and see that the asset is not under any construction, or the asset is not being progressed any further. In the sense that you can just go to the plant, take a visit, and ensure that there is no further work that is being done to the asset, and all efforts are made to scrap the asset. So if you get a comfort over the fact that efforts are being taken to scrap the asset, and you also get comfort over the approval, then you can move on in life and say that, okay, the write-off is also fine, and you can trace the amount that was written off back to the earlier period CWIP listing and ensure that the amount is also tying out there. I hope you understand this, guys. And transfer to PPE. So for the asset that is getting completed and getting moved from CWIP to PPE, there is no separate testing which you actually need to do, but I will discuss that now. Just a moment, guys. So what we will basically do is, in our case, we saw that 30 was the transfer to PPE, guys. So basically it means that 30 is getting removed from CWIP and getting moved to PP. First, we will check the completeness of this, guys. And what we will see is, if 30 is getting removed from here, we need to ensure that the addition in PPE is also 30. This is the first level of completeness comfort which we need to get, guys. I hope you understood this. In relation to the subsequent aspects of this, we will discuss this while we are covering PPE, guys. You will have a better perspective when I discuss it at that time as against discussing it now. Right? Perfect, guys. Yeah. Next. How to analytically look at CWIP. Guys, this is a very beautiful concept. This is a concept which many people find it difficult to comprehend and grasp, but guess what? I'm going to make it very easy for you guys. I'm going to make your lives easier. This is a very, very interesting concept. You need to apply a bit of your mind, right? So let's just get on here, guys. I hope the entry flow is visible. So guys, so what is the entry flow for CWIP and capital advance? Let's say you gave an advance of 100 to your creditors to construct a water plant. What would be the entry you're passing, guys? You would simply pass the entry capital advance debit 100 to bank 100. And this capital advance would be classified under other non-current assets because this is in relation to a project and a project is meant to be long-term. Hence, it would go under the non-current bucket. I hope you understood this, guys. Next, let's say materials worth 110 were received. So, guys, think logically. Materials worth 110 were received and you already paid an advance of 100 to your vendor. So, what is the remaining amount you need to pay now? 10, because out of 110, 100 has already been paid. The residual 10 just needs to be paid. I hope you understood this, guys. So what would be the entry you would be passing here, guys? You would be debiting CWIP to the extent of 110 because your materials have been received. You would credit your capital advance to the extent of 100 because the capital advance is getting knocked off now. Because the capital advance which you had earlier given as an asset, that asset is getting knocked off because that is being used to settle a liability, which is your capital creditor. Then the residue would go to your GRIR to the extent of 10. Then your GRIR would be debited and your capital creditors would be credited. Hence, your GRIR would be knocked off from your books. So the 10 in relation to capital creditors would be classified under other financial liabilities. Why other financial liabilities, guys? Because you owe an amount to your capital creditors, which you need to settle in cash or cash equivalent. Hence, the same would be sitting under other financial liabilities. Then when you settle your capital creditors, you would pass the entry, capital creditors debit 10 to bank 10. I hope you understand this, guys, and I hope it's clear up till now. So, guys, you just need to ensure that the credit is going to capital advance to the extent of 100. Because sometimes what clients might do is, they might take the entire credit to capital creditors, which is actually not right because you need to first knock off your advance and then take the residue to capital creditors. Because if you take the entire 110 to your capital creditors, what would end up happening is your asset balance of capital advance would also be inflated. Your liability balance of your capital creditors would also be inflated, which is actually not right. You're not giving a right presentation or a right understanding to the users of the financial statements. I hope you understood this, guys. This is a very critical concept, and this entry flow is very critical for your understanding and for your audit. So basically, the analytical part of it, which I wanted to convey here is, if you see here, as and when your CWIP is getting increased, your capital advance is getting reduced. So what you have to see at a broad level is, if there is an increase in your capital work in progress, that should ideally be a decrease in your capital advance. So that is what you have to see from a very, very broad perspective. And you also need to ensure that if there is a particular vendor, there should not be an inflated capital advance balance against that vendor and an inflated capital creditor balance against that vendor. It should only be one of these. So a vendor can either have a capital advance balance or a capital creditor balance. If a vendor is having both these balances, it means that the entity has failed to net the same off, and you have to tell the client to net it off and show it at the net level because that is the right presentation. I hope you understood this, guys. Let's just proceed on further. Yep. Just a moment. Hey guys, just presenting my screen again. Just let me know if it's visible. Yep, I think it's visible now. Yeah, guys. So we just got done with how we need to look at CWIP analytically, right? So let's just look at how the CWIP is disclosed in the annual report of a company. Let's just look at an actual disclosure and get an understanding of how this works. So what they've just basically said is projects in progress for financial year 23-24 are so much, less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. And as at March 31st, 2023. Projects in progress 8377, 41, and this is the total. So there have been no projects that were temporarily suspended here. So what we are basically trying to say is these are the projects in progress, and projects amounting to 28358 are less than 1 year, while in the 1 to 2 years bucket, there is an amount of 3. So basically, how do we arrive at this disclosure, guys? Very simple. Let's say there is an CWIP ID A. Let's say to compute this aging, what we need to do is we need to check as to when the CWIP ID entered into the CWIP listing. Let's say for the financial year 23-24, it entered for the very first time during July 2023. So in such a scenario, this would be classified under the less than 1 year bucket, right? Let's say the same entered maybe somewhere in July 2022. So in such a scenario, the same would be classified in the 1 to 2 years bucket for the financial year 23-24. I hope you understood this, guys. Basically, when you extract the CWIP listing given by the client, you will be able to see the CWIP dates there. So that is the time when the item first entered the CWIP listing, basis which you can arrive at the aging, guys. I hope you understood this. Suppose if there is anything in the 2 to 3 years or more than 3 years bucket, you just need to understand the reasons for delay, guys, as to why there is a delay, or is the company deliberately delaying it to avoid depreciation charge to P&L? Because if an item is in CWIP, you don't need to depreciate the same. You need to inquire the client. You can probably physically visit the place where the asset is actually situated, and you can understand whether the asset is actually completed, or is the entity deliberately like delaying the completion to avoid a depreciation hit to P&L. You can probably get an understanding of this, guys. I hope you understand this, guys. Next is your completion schedule of capital work in progress whose completion is overdue. Guys, here basically what they are trying to say is, let's say you plan to complete a project on a particular date, but let's say you were not able to complete the project on that particular date. So there is a delay in completion as against the date you had initially expected, right? So that is what they are asking, guys. So what they are saying is, let's say you expected to complete a project today, but let's say even after 7 months the project is not yet completed. So in such a scenario, this would be under less than 1 year bucket. In the sense, how we would be computing is, we would basically be getting a schedule from the client as to what is the date of completion for a particular project which the client initially expected, as against the date of March 31. Let's say the client probably expected to complete the project in July 2023, but the project is still outstanding as at March 31, 2024, and is still coming in your CWIP. It means that there is a delay of around 8 months, or 7 or 8 months or 9 months, right? So in such a scenario, there is a delay of less than 1 year. However, let's say the project was supposed to be completed in July 2022, but is still outstanding in CWIP as at March 31, 2024. In such a scenario, it would come under the 1 to 2 years bucket. I hope you understand this, guys. These are the disclosures which we are required to give under Schedule 3 mandatorily. I hope you understood this, guys. Yep. And so I've explained this case and possibility of unpredictability procedures in CWIP. Okay, so one of the unpredictability procedures which I highly recommend is probably going and visiting the asset, seeing whether the asset is actually there in place, seeing the like relevance of the asset, getting an understanding from the people on the technical side as to what is the actual status of the asset, because technical people have no financial interest in the company to manipulate the financials, right? It's only the finance team which might even have an idea of manipulating, or doing, or trying to like manipulate or try to show a false picture, right? So the technical people wouldn't have a vested interest in doing so. So they are the best people to be probably speaking with and getting an understanding of CWIP. And you can probably visit on site and get an understanding, because they won't be doing any window dressing, right? It's usually the finance people who will try to do window dressing. I hope you understand this, guys. This is a sort of unpredictability which you probably could end up doing as an auditor, right? Okay. Next, this is a PPE note reference from the annual report of a company. We'll just look at it once we are done with PP. So here I've just given PPE below. So PPE audit strategy. First, we need to look at the completeness of PPE, guys. Why do we need to look at completeness? FAR versus GL reconciliation. Some of you might be wondering, what is this? Guys, very simple. FAR is the fixed assets register and GL is your general ledger. So why is this important, guys? Similar to how we saw a payroll versus GL reconciliation in our payroll audit practically series, this is important because the numbers in the GL automatically flow from our fixed asset register. So in your enterprise resource planning systems or in your accounting systems, you will have a module called fixed assets module. So what would happen is, whenever an asset is getting added, it would get updated in the fixed assets module. And whenever an asset is getting removed, it would get updated in the fixed assets module. So whatever is happening in the fixed assets module will automatically get interfaced with your general ledger, and that will be passed as an accounting entry there. Right? I hope you understand this, guys. So in this scenario, ideally, we will be selecting samples from our fixed asset register and not from our general ledger. Why is it, guys? Because let's say there were 4 assets that got added in a particular month, and the total of that addition was rupees 20. So if you go to your general ledger, the entry that would have simply been passed there would be asset account debit to bank 20. However, we wouldn't have the asset by split for the 4 assets in our general ledger, which is why we need to go to our fixed assets register. So we need to get comfort over the fact that our fixed assets register is complete, because that is the base which we are using for our sample selection. I hope you understand this perfectly, guys. So that is why we do a reconciliation between our fixed assets register and our general ledger to check whether the same is matching. Yep. So, and there is and we look to match at the gross level and the act up level as well, guys. Let's say the gross block as per the fixed assets register is 100. The gross block in your general ledger code should also be 100. And let's say the act up as per your fixed assets register is 20, the act up in your general ledger should also be 20, thereby deriving a net balance of 80. But guys, if there is an Ind AS transition at the gross block and act up level, the same wouldn't match perfectly. That is, your gross block number as per your fixed assets register would not match with your general ledger, and your act up as per your FAR would not match with the act up as per your GL. However, at the net level, it would match. That is, the 80 as per your FAR would tie out to the 80 as per your general ledger. However, at the gross and the act up level, it wouldn't match. Guys, I have decoded this logic as a part of one of our logical shorts. You could check that for an elaborate understanding of the same. I don't want to be explaining the same here. Yeah. So next is one reconciliation item which you usually get in your FAR versus GL reconciliation is your borrowing cost capitalization. If you look at Ind AS case, Ind AS 23 talks about borrowing cost capitalization. That is, it tells that a certain part of the borrowing cost should not be taken to P&L, but it should be taken to the asset and capitalized as a part of the asset cost. In such a scenario, what would happen is, since your FAR is an automated report, your FAR wouldn't be having this component of borrowing cost. However, this would be present in your GL. So I've taken an example here to explain this. Let's say your net book value as per your FAR is 100. Let's say the borrowing cost capitalized is 20. So your GL should be highly 120. So in this scenario, what would happen is your GL would be higher, but your FAR would be lower because your borrowing cost does not go into your FAR because it's a manual adjustment which you're doing as an entity. I hope you understood this, guys. So this is usually a typical reconciling item that appears in your FAR versus GL reconciliation. And there aren't much reconciling items like your payroll versus GL reconciliation while doing a FAR versus GL reconciliation. I hope you understood this, guys. Next, testing strategy. Okay, let's say there is an addition in PP amounting to rupees 100, right? So many of you would be saying this should perfectly match with the CWIP deletion, right? Guys, you're partially right, not completely right. I'll tell you why. So let's say the addition in PP is 100. Let's say this is bifurcated into two parts, 80 and 20. Let's say there is a deletion from CWIP amounting to 80. Let's say there is another 20. You guys might be wondering, what is this 20? Guys, there are some assets which do not require any assembly or any erection to be done, right? For example, your cars, your laptops, or your vehicles, they don't require anything to be done for them to be ready for internet use, right? They are immediately ready for internet use in 99.99% of the cases, right? So these assets would not be routed through CWIP addition and then get removed from CWIP. These would directly be added to PPE because they are ready for internet use. So this is the 20 which we are referring to here. I hope you understood this, guys. And next, what we need to ensure is, as I told you earlier, this 80 which is getting deleted from CWIP, we need to ensure that this is tying out to the deletion as per CWIP. That is, we need to ensure that the deletion from CWIP is also 80, right? I hope you understand this case, because the transfer out in CWIP or the deletion in CWIP should perfectly equal to this 80. Logical? Yep, perfect. Next. So this is how we are matching our completeness case. And as I told you earlier, for the transfer out from CWIP, the entry you would be passing is PP account debit to CWIP. And for the direct addition in relation to your vehicles or your car or your air conditioner or any other furniture, the entry you would be passing is PP account debit to GRIR. So for this, guys, if you just think logically, for the transfer out from our CWIP, basically what would have happened is, I'll just go a bit up and I'll just give you a recap. So yep. So if you see the transfer to PP here 30, ideally this is coming from our opening balance. Like we have an opening balance of 100, out of which, assuming that it happens on FIFO basis, 30 is getting transferred out from the opening balance. So basically, or let's say if this amount was, even if this amount is 130, 100 would have been from the opening balance on FIFO basis. Or sorry, if this had been 110, 100 would have been from the opening balance on FIFO basis, and 10 would have been from our addition. So in both the cases, if you see, the 100 is already tested as a part of our prior year audit, and hence we are just ensuring the tracing of the same. And the 10 is already being tested as a part of our CWIP additions. That is what is ideally getting removed. So you don't need to do a separate testing for transfer to PPE, guys. I hope you understood this, because this transfer out is happening from the numbers which you have already tested. So we don't need to do a separate testing for the transfer out. This is, I hope this is very clear, guys. Yeah. Just coming down again to this place. Sorry. Yep. Just going a bit up. Yeah. And so that is why we are not talking about any testing strategy here, guys. So what we are just saying is, for the 20 of direct additions, we need to do a testing because these were not routed through CWIP, and hence they would didn't have even gone through the CWIP balance. So we need to do a separate testing. And again, we need to take the columns which we took in similar to CWIP, guys. Like basically we trace our invoice number, PO number, GRN number. We look at the gate inward number, gate inward date, your GRN date, PO date, and we do all of that, right? I hope you understood this. And one more important thing which I failed to stress is I had written that as a part of the notes there, but you have to look at the quotations, guys. In the sense, let's say an entity is procuring a particular material for CWIP or a vehicle or an air conditioner that is getting purchased, you need to look at the quotations, guys. Why are quotations important? Because this is more of a process aspect of the entity. Let's say the entity will usually look to procure the asset or the material from the person who's quoting the lowest price. So you need to check that if there are like 2-3 quotations, the asset is purchased from the vendor who's quoting the lowest price as a part of the control check. Because if the asset is not purchased from the person who's not quoting the lowest price, there could be a possibility of collusion, which you need to understand. But there are practical business reasons due to, in some cases, where the entity would not be purchasing from the person quoting the lowest price. Entity would be purchasing from the person quoting the second lowest price, because the entity might have a better relationship or better commercial relationship with the person who's quoting the second lowest price as against the person quoting the lowest price. So you need to understand the business aspects of these reasons, and you also need to be confident and get comfort over the fact that the people at the top are also aware of this. That is, the people who are the process owners for this are also aware of the fact that the lowest quotation was not actually taken into account, but the second lowest was taken into account. I hope you understand this, guys. Yep. Next. Another thing which we need to do is, basically, as I told you earlier, for the amount that is getting routed from CWIP, that is the 80, we don't need to do a separate testing, but we need to check certain attributes in relation to this case. Let's just come down a bit and I'll explain you what are the attributes we need to check. So basically, the 80 would get transferred from CWIP ID to asset ID, right? Yes. So we need to take our fixed assets register or our additions listing and check what is the asset ID. When was it capitalized? That is, when was it removed from CWIP and when was it moved to PP? And what is the description of it and what is the amount? And we need to check when is the date of the capitalization as per the capitalization certificate. Okay, so what is capitalization certificate? Basically, capitalization certificate is a certificate given by someone who has technical competence or technical knowledge about a particular asset. He could be someone who is internal to the organization or even someone who is external to the organization. So basically, capitalization certificate will contain a description of the asset, the useful life of the asset, and the basis for the useful life of the asset. And you also need to check whether the classification of the asset is appropriate. Why is this important, guys? Because what would happen is, let's say the description when the asset was in the CWIP listing was building or something like that. But let's say when it is getting capitalized, it is getting capitalized in plant and machinery. That is a control lapse case, because in CWIP, when it was a part of some building material, when it is getting capitalized, it also needs to go into building capitalization. This is important, guys, because for each class of property, plant and equipment, there are separate depreciation rates and separate useful lives that are prescribed in your schedule, okay, for as per Companies Act for depreciation, right? So this is very important, because your plant and machinery would have different useful lives as per your schedule, while your as per your schedule 2, while your buildings should have different useful life as per your schedule 2. So this is very important to ensure that whatever was the initial classification in CWIP, that is what is getting continued while the asset is getting capitalized. I hope you understand this, guys. And your amount as per your CWIP listing, that is, if let's say a particular material or a particular CWIP of 10 was removed from CWIP listing, only 10 should get added in the PP listing. That is again something which you need to ensure at your sample level as well. I hope you understood this. And your useful life. Your useful life is important, guys, because your schedule 2 as per Companies Act gives useful lives for various categories. So there is no hard and fast rule that the useful life which is specified in schedule 2 has to be adhered to by an entity. An entity can adopt even a higher or a lower useful life from schedule 2. But an entity needs to have a basis or a backing as to why it is taking a useful life that is different from that prescribed in schedule 2. If that is there, everything is perfectly fine and you're good to go. I hope you understood this, guys. That is what I've given here, saying that check whether it's in line with schedule 2, because this is very, very important. And if it is not in line, you need to get an understanding as to why it is not in line. And a disclosure has to be given in the financial statement saying the useful life which is prescribed in schedule 2 for buildings is so and so, but the useful life which the entity has adopted for the purpose of depreciation is so and so, to let the users know that the entity is having a deviation from schedule 2, and we as auditors are also aware of the same. I hope you understood this case. Yeah. Next, I'll just read this out and I'll just explain this. The useful lives of assets working on shift basis have been specified in the schedule based on the single shift working. Except for assets in respect of which no extra shift depreciation is permitted, if an asset is used for any time during the year for double shift, the depreciation will increase by 50% for that period, and in case of triple shift, the depreciation shall be calculated on the basis of 100% for that period. It's very simple. What they're trying to say is, in Schedule 2, let's say the useful life given for a particular asset is 10 years. So, and let's say the cost of the asset is 100. So what you would simply say is 100 divided by 10, rupees 10 would be the depreciation charge for every year, assuming SLM basis is followed. Perfectly right. But let's say an entity adopts double shift for that particular asset. In the sense, the entity operates that in two shifts. That is, so when an entity operates an asset in two shifts, the asset is more prone to wear and tear, right? The asset is used 2x, that is double its normal usage, right? So in this scenario, what we would do is we would accelerate the depreciation charge. So since 10 is the useful life for normal usage, for 2x usage, the useful life would get reduced to 5 years, basically 10 years by 2, which would become 5 years. So if you look at the depreciation charge now, it would be rupees 100 of the asset cost divided by 5 years, because we are accelerating our depreciation, thereby leading to a depreciation charge of rupees 20 per year. I hope you understood this, guys. Guys, and one more thing which I want to mention is, sometimes while doing the technical evaluation, the technical valuer would already take into account the shift depreciation. You need to understand from the technical valuer whether he has taken the shift depreciation into account while arriving at the useful life. If he has taken the same into account, great, you can just divide by the useful life which is given you straight away. But if he has not taken that into account, you need to take that into account and recompute the depreciation and match it with what the entity has computed. I hope you understood this, guys. And there are other things which Schedule 2 says, which I'll just explain to you. The useful life of an asset shall not be ordinarily different from the useful life specified in Part C, and the residual value of an asset shall not be more than 5% of the original cost of the asset. Yes. As I told you, like, your Schedule 2 useful life should ideally be the useful life that has to be adopted. But if there is a deviation, the same has to be specified, and a deviation is definitely permitted. It is well within the law, right? I hope you understand this. And for residual life, what they're saying is, let's say your original cost of the asset is 100. The maximum residual value which you can take for the asset is rupees 5. You cannot take a residual value more than that. And it's saying that provided where a company adopts a useful life different from what is specified in Part C, or use a residual value different from the limit specified above, the financial statement shall disclose such a difference and provide justification. As I said earlier, let's say the entity takes a residual value of 6. In such a scenario, the entity again has to disclose in the financial statement, similar to the useful life, saying that the residual value which ideally has to be taken for the asset is 5, but we as an entity have taken 6 because we expect that in the years to come, when the useful life gets over, we will be able to realize it at higher than 5%. That is, we will be able to realize it at 6 instead of 5. I hope you understood this case. But in relation to residual value, I have not really seen a deviation from Schedule 2. Entities 99.99% adhere to Schedule 2. It's only in useful life where there are deviations, and where the deviations are usually backed by reasons. I hope you understood this case. Just coming down a bit. Yeah. Just give me a moment, guys. Just a moment. Yep. So another important thing which I just wanted to tell you is, guys, let's say there is a sub asset. The useful life of the sub asset cannot exceed the useful life of the main asset. In the sense, let's say there is an aircraft. Let's say the aircraft has wings. Let's say the useful life of the aircraft is 10 years. But let's say the wings have a useful life of 15 years. But guys, in such a scenario, you will restrict the useful life of the wings to the useful life of the main asset, that is the aircraft. You cannot take a higher useful life for that unless it is a significant part. Let's say you conclude that the wings are a significant part of the asset or a significant component, then you can take the useful life of 15 years for the wings, or else you would have to restrict the useful life to the useful life of the main asset. I hope you understood this, guys. Next is PPE deletion. So let's look at the deletion of PPE. So basically, PPE deletions are basically a scenario where you're removing the asset from your books by selling the asset or scrapping the asset. Both of these are possibilities in relation to PPE deletion. Guys, you need to be a bit analytical here. So some of you might ask a very skeptical question as to, if the entity is taking the help of a valuer to give us the useful life, how will we get comfort over the fact that the useful life is appropriate? Because we are not technical experts. We don't have scientific knowledge. Some of you might say that we would involve an auditor's expert, right? Involving an auditor's expert is definitely a possibility, but practically in most of the cases, we do not involve auditor's expert. What we instead do is we scan the FAR. Like, in the sense, what we try to see is, let's say there is a sale of an asset before the useful life expiry. Let's say the useful life of an asset is 10 years, but the entity sold the asset in the 8th year itself. We'll try to understand from the entity, asking them, saying, you estimated the useful life to be 10 years, but you sold the asset in the 8th year itself. Why is the reason? Because if you sold the asset in the 8th year, it is presumed that the asset was valid or asset was in good working condition only for 8 years. So you should have ideally taken the depreciation over 8 years and not 10 years. So you need to understand from the entity as to whether the sale was just a one-off case or whether this is the case in relation to the other assets as well. Because if this is the case in relation to the other assets as well, the useful life for similar assets has to be revised to 8 years instead of 10 years. And that would lead to a scenario where the depreciation would get accelerated. I hope you understood this, guys. And another scenario where you can look at analytically is, let's say the useful life of 10 years is over. And in such a scenario, the net book value would be zero, right? Because the asset would get depreciated entirely. So what you as an auditor have to ensure that is that the physical quantity of the asset should be mentioned in the FAR. Just because the net block is zero, it doesn't entitle the entity to remove the physical quantity from the FAR. Because the asset is still in your premises, the physical quantity has to be mentioned against the asset, because this would lead to issues in CARO reporting if the physical quantity is not correct. I hope you understand this, guys. Again, for PPE deletion, there are some documents which you need to check. You need to check the invoice for sale. You need to check the bank statement to ensure that the amount has been actually received by the entity. You need to check the gate outward to ensure that the asset is actually moved outside the premises of the entity. You need to check the quotations which the entity has entered into. This is basically the reverse case, because the entity will look to sell it at the highest price which they are getting. You need to see whether the entity is going through an auctioneer. If the entity is like looking to sell the assets through an auctioneer, you need to understand the process of how the auctioneer ensures that the auction goes in an unbiased manner. You need to ensure whether an entity's representative is also attending the auction to ensure that the sale is unbiased and is given to the highest bidder and not in a biased manner. That is something you need to check from the process perspective and the controls perspective. And you also need to check if the gain or loss on sale has been treated appropriately. I've just given you the basic journal entries for PPCL. Basically, bank account debit, your ACDEP will be debited because you would have earlier credited your accumulated depreciation. You're reversing it now. Then you will credit your PP to the extent of your gross block value. And your balancing figure, if it comes in the debit, it would be a loss. And if it comes in the credit, it would be a gain. I hope you understood this. Now, let's just look at the CARO reporting part of it, guys. Just a moment. Zooming it a bit. So basically, the company is maintaining proper records showing full particulars, including quantitative details and situation of property, plant and equipment, right of use assets, and investment property. Basically, the quantity which is physically available has to match with the quantity in the FAR. Let's say there are 3 assets physically available. In your FAR also, the quantity has to be 3. It shouldn't be 4 or it shouldn't be 2. I hope you understood this. Situation. Let's say the asset is situated in a plant in Hyderabad. In your FAR, the location should be mentioned as Hyderabad or HYD or whatever coding or whatever tagging the entity is following in its accounting software. I hope you understood this, guys. And the company is maintaining proper records showing full particulars of intangible assets. Again, for intangible assets, this is there. Then the property, plant, equipment, right of use assets, and investment property are physically verified by the management according to a phase program designed to cover all the items over a period of 3 years. So, guys, if you look at the CARO guidance note, it says that the assets have to be covered over a period of 3 years. But however, the entity can also cover it on an annual basis. The 3 years is just a time frame or a suggestive time frame given by the CARO reporting framework. The entity can also choose to cover it physically or even biannually or even once in 2 years. That is perfectly fine. Then, pursuant to the program, a portion of the property, plant, and equipment has been physically verified by the management during the year, and no material discrepancies have been noticed on such verification. So, basically, for this, you have to take the count sheets of the management and do some work in relation to this. I'm just coming down to this, guys. So basically, the management would have done physical verification of PPE. So in some cases, you will also attend the physical verification of PPE, which is usually an unpredictability procedure. There is no compulsion for you to attend the same. But however, as a part of unpredictability, you can definitely attend your physical verification of PPE to get comfort over the fact that everything is perfectly fine. So let's say you are getting the PPE management count sheets for the count which is done by the management for property, plant and equipment. you will do a two-way comparison for sample assets. That is, you will check whether the quantity as per your fixed assets register is matching with your quantity as per the management count sheet. Let's say there is an asset A. Let's say the management has noted that the asset A has a quantity of 10 assets. So the quantity as per the FAR also has to be 10. You will check you will do a mapping from FAR to the count sheet and count sheet to the FAR as well. So it's like floor to tag and tag to floor as well. I hope you understood this, guys. So this is how your template would ideally be. Like your serial number, asset ID, asset description, your quantity as per your FAR, quantity as per physical verification and management count sheets, and the difference. I hope you understood this, guys. And next is this clause requires the auditor to report whether the management has verified the property, plant, and equipment at reasonable intervals. What constitutes reasonable intervals depend upon the circumstances of each case. So this is what they are saying. While an annual verification may be reasonable, it may be impracticable to carry out the same in some cases. Even in such cases, the verification program should be such that all assets are verified at least once in every 3 years. So this is the guidance which I was talking about earlier, about just a few minutes back. I hope you understood this. While verification of, this is very important, guys, let's just give this a read. Where verification of all assets is not made during the year, it will be necessary for the auditor to report that fact. But if he is satisfied regarding the frequency of verification, he should also make a suitable comment to that effect. Guys, what they're trying to say is, let's say there is a plant, let's say there are two plants for a company. Let's say plant A is one of the plants and plant B is one of the plants. Let's say this is the first year of the physical verification program for the company. Let's say the company covered plant A as a part of physical verification in year 1. Let's say the company covers plant B in year 4. Like, let's say there were a lot of capitalizations in plant A. That is, there were a lot of PPE additions in plant A in the intervening 3 years. But the company is saying that, boss, we have already physically verified plant 1 in year 1. Hence, in year 4, we are not doing it. But you as an auditor are arguing, saying that there are significant capitalizations in plant A which ideally need to be counted because the value is material there from a financial standpoint. So here you can, as an auditor, take a professional judgment and say that even though CARO 2020 gives me a time period of 3 years, but the addition here is material and it needs to be counted, but the management has not counted. Hence, you will express a negative remark in your CARO. However, let's say the additions were not material, were very immaterial in plant A. At the time, you would give a positive remark and you would not express a negative remark. I hope you understood this, guys, and I hope this is clear. Yep. Just moving up a bit. Then the title deeds of all the immovable properties are duly executed, are held in the name of the company, except for the following. So guys, what they're basically trying to say is, ideally, when you're purchasing a property, when the company is purchasing a property, the property has to be purchased in the company's name. It is telling you to report if the property is not purchased in the company's name. So here, this is a scenario where they are saying that this is the reason for the property not being held in the company's name. The company is in the process of registering the said flats in its name. The flats could not be registered due to a dispute of the builder with the Haryana government towards payment of development charges. So basically, in this case, the ownership of the property is in the entity's hands, but the title deed of the property is not in the entity's name due to a dispute or due to a delay in the same getting registered in the entity's name. I hope you understand this case. And next point, this is something which I'll make you understand, guys. As referred to in note 2 to the standalone Ind AS financial statements, the company had carried out name change or various mergers or amalgamations across various years. Pursuant to these actions, the company holds certain immovable properties wherein the title of the property has been conveyed or transferred to the company pursuant to such scheme of amalgamation or arrangement, and the management has represented that these are considered as valid title to the immovable property and no further actions are necessary. Okay, so what they're trying to say here is, let's say I am company A. Let's say I acquired company B a couple of years back. So company B would have had certain property, plant, and equipment, right? Ideally, what would have happened is company B, the property, plant, and equipment of company B would be in company B's name. That is, in the title deed, company B's name would be appearing. But right now, at present, company B is not even a separate legal entity because it has been acquired by company A. So if I look at the title deeds of the properties that were acquired by company B, they would obviously be in company B's name. So that is what we are trying to say, that they would be in company B's name, but we as auditors have got comfort from the management through letter of representation and through the fact that since company B has been acquired by company A, obviously the properties of company B would be passed on to company A and would be appearing in company A's fixed assets register and ultimately in the financial statements. I hope you understood this case. Next, the company has chosen cost models for its property, plant, and equipment including ROU and intangible assets. Consequently, the question of us commenting on whether the revaluation is based on the valuation by registered valuer or specifying the amount of change, the change is 10% or more in aggregate. Just a moment, guys. 10% or more in aggregate of the net carrying value of each property, plant, and equipment, including right of use asset or intangible assets, does not arise. Yes, what they're telling us is, so if we are following revaluation model, we need to get the valuation of the property done by a registered valuer. For example, what they're trying to say is, let's say for each class of property, plant, and equipment, let's say land and building is a class of property, plant, and equipment. Your furnitures and fixtures are a class of property, plant, and equipment. What they're trying to say is, let's say your furniture and fixtures value was rupees 100, the net book value. Let's say at the year end, when the registered valuer did the revaluation, the value comes out to 120. In such a scenario, you would have to report in your CARO saying that there is a variance of 10% or more, because ideally, if it had been 109, it would have been perfectly fine. If it had been 110, it wouldn't have been fine, because the change is exactly 10%. Even if it is exactly 10% for that particular category, that is in our example, the furnitures and fittings, it has to be reported in clause D. I hope you understood this, guys. Next, based on the informations and explanations furnished to us, no proceedings have been initiated on or are pending against the company for holding Binami property under the prohibition of Binami Property Transactions Act and rules made thereunder. And therefore, the question of us commenting on whether the company has appropriately disclosed the details in its financial statements does not arise. So basically, what they are trying to ask us is whether is the company holding Binami property, that is the company holding the property on behalf of someone else as a part of Binami transactions. And this will mostly be no in cases of almost all the companies. So this is what they're asking us to report, whether the company is holding the property as a Binami, that is on behalf of anyone else or any other company. I hope you understood this. That's it, guys. This is the next clause in relation to inventory. So this is not of relevance now. We will discuss this when we do the audit practically video in relation to inventory. Just a moment, guys. Just stop the share. Guys, thank you so much for tuning into the session. I hope you found this session insightful. So for more sessions like this and for more insightful videos and for more content that is of genuine value addition, do hit that subscribe button to the channel. Keep learning, keep growing. Thank you so much. And if you want a specific FSLI or if you want any particular concept or any video in relation to financial reporting or audit, do comment down below and I'll be more than happy to do that. So cheers, guys. Thank you so much. Keep learning, keep growing. We'll meet you soon. Thank you.